Hi guys, and welcome back to another episode of What's on Your Mind. Today on the call, I've got two ITPM senior trading mentors joining me. That is Jason McDonald and Ben Green. Ben's actually been with ITPM for a little while now, but this is his first outing, his debut onto What's on Your Mind. So it'll be really great to hear from him. And Ben, welcome to the show.
Thank you. Looking forward to it.
So we've seen a bit of a rally over the last month or so in equities, haven't we? S&P's at all-time highs ish. That's of course since the positive vaccine news that we've seen, and within that rally, to me, something that's stuck out and been quite interesting is there's been some quite distinct winners and losers and a bit of sector rotation going on. But enough of that. I want to hear what you guys are thinking. And Jason, I think we'll start with you. What's been your take on markets over the last few weeks?
Yeah, hi everybody. Well, obviously we've had a great run during November. So not just at the market level, but as you've kind of intimated there, we've had some real outperformers with respect to some of the sectors. So I mean, I think we just had the strongest S&P on record, S&P 500. And I think it's not the best, but it's one of the very best Novembers for the Nasdaq as well. And within that, you've seen some interesting dispersion of returns as well. So we've got basically at the top of the leader table for November, we had energy and oil, which is obviously not a surprise given the way the news flow has gone with vaccines and potential reopenings, etc. The Russell 2000, the small cap index, was actually up 18% during November, which is pretty extraordinary. You saw a big bounce in the financials. And as one might expect, in terms of the underperformers, it's been stuff like, consumer staples, healthcare, utilities. Gold has been a pretty bad underperformer as well in the last month. So, as I say, whilst we've seen a strong overall market, we've also seen some massive disparities of performances there. I mean, I think energy was up 27% as a sector last month. So, in terms of overall where we are, we obviously had a fairly technical situation going into the presidential election, but which seems ages ago now. I mean, it's only almost a month ago, and then of course after that was unwound, we then got the vaccine news, which seemed to be every Monday there was a new vaccine announcement. So it's clearly driven a lot of people back into the market, and I think some hedges have been taken off. So, and the other thing that I've noticed is that we've now got the VIX has basically halved since the eve of the election. It's gone from over 40 to now down to about 21. So I think for me, we've had a great run, and overall where we are now, as you said, near all-time highs again. I'm getting a bit more cautious now. So we were always talking about being long short. I've been quite long during November, and I've taken advantage of some of those moves to lighten the load a bit. And I'm definitely, becoming a lot more balanced now on the exposures. And I know that Ben's been looking at that as well. I mean, in terms of the kind of latest news, we're obviously now expecting some kind of stimulus movement, which has given the market another kind of move up. And yesterday we had the ISM numbers coming out in the US, which were showing again that we've got expansion overall on the manufacturing side, which is of course what we need to see. I know that Ben's got some kind of sectoral insight on that as well, which he's going to probably go into during one of his trade ideas. So yeah, it's been a very interesting month, and probably a month that a lot of people didn't foresee, I'd say.
Sure, sure. Well, Ben, let's go over to you then and talk about one of those ideas. What have you got for us today?
Well, a stock that I've been looking at is Garmin, GRMN. And before I get into it, let me just kind of continue on Jason's thought as far as the ISM. The ISM was strong, but it was actually weaker. It was a slower expansion in November than we saw in October. So there's a sense of, yeah, it's, it's firm, but the momentum is kind of slowing down. But what stuck out really to me from that more, though, was a lot of the respondents are talking about supply chain issues. On the back of COVID, it's really hard for a lot of these guys to get enough workers, actually, because it's now with all the new testing going on, as soon as somebody is positive, they have to go on a 14-day quarantine, and then they have to be replaced by somebody else who needs to get retrained and so forth. And most of the respondents were mentioning this and talking about possibly disruptions in the supply chain coming from China and other countries. Actually, the worst, they actually mentioned where I live in LA, the Port of Long Beach actually being one of the biggest problems. That said, that could, and I think that could have potentially a negative impact on consumer electronics. I mean, actually seeing some of that effect today as Best Buy is trading lower. Could be, other people are starting to have the same idea. That said, though, Garmin is kind of on its own because it's not a typical consumer electronics. It has a much wider distribution network, and just underlying business fundamentals is on a much broader scope. So, I kind of got into this idea because I'm really into boating and outdoors and fishing and all that stuff. And a little while ago, I was looking to upgrade my boat, and I was talking to a dealer down here in Newport Beach, and the boat I'm looking for is actually sold out until June of next year. So there's a huge backlog of boats and other recreational vehicles and stuff that people want and they just can't get. And then when people actually get these products, they need navigation equipment put in, which happens after. So even though they might have paid for boats and RVs and whatever before they get them, they typically then, when they get them, go out to buy electronics, navigation equipments, and all that. So, and that's what Garmin does, obviously. Garmin was used mostly in autos back in the day, but it's that whole auto segment is being phased out, and now it's actually getting much firmer into aviation, marine, outdoor, and also fitness. So, and it also goes to the whole theme of a lot of people, trying to do more stuff outside, at least here in the States. I know some countries in Europe, you can't even go outside, basically, but, over here, the market is definitely heading in that direction. So, so Garmin is, is not one of the fast growing stocks with high Ps that we're used to. All right. But, like Jason was alluding to, we're now in an environment where, we're getting pretty toppy. It pays to be probably more selective. And this stock is a steady grower. It has high margins, 20% plus margins. And there's also other qualitative factors that make up for the slow growth. I'm going to talk about in a minute. On the revision side, there's been kind of uptrending revisions across the board, pretty much. So we're looking at basically analyst community starting to look at this idea also and start to crank the revisions a bit higher. And that goes for earnings and sales. The company released earnings in mid-February. All right, so we still have some ways to go. So yeah, some comments on the business. Due to inventory constraints, there was a slowdown in new boat shipments earlier this year. However, the National Marine Manufacturing Association, they states that we expect shipments will pick up as supplies are replenished, which reflects initial data coming in for October, showing an easing of supply chain constraints. So this is encouraging news as manufacturers are working to meet the influx of new orders for boats. So there's not a problem with orders, okay? There's a problem with basically building enough boats and delivering enough boats. And that's just boats. This business is a lot more going on than just boats. But that's just an example. So some of the KPIs here, I didn't mention outdoor and fitness, and Garmin is now really into like handheld devices and GPS watches and all this type of stuff. The weakness of the business over the years has been in the automotive business. It's obviously now everybody's using their phones, or built-in GPSs in their cars, but that's becoming phased out, and you can see that on this chart. That part of the business is just basically gonna be completely phased out, and then the whole focus is going to be on the 5 core business segments, and that focus should be a lot stronger going forward. So that's going to add to the bottom line, and the growth rates that we've seen should reflect this and increase, because excluding the automotive segment, top line growth is actually more than 20%, and it's triple the rate since 2012. Garmin also been able to improve gross margins while spending more in R&D and sales relative to revenue, and you can see that on this chart as well. The biggest, most exciting thing for me, because I used to be a pilot, so I had a lot of connections in the airline and corporate aviation field, and they were talking about the big thing being avionics, and it's basically now ruled by Garmin. So with everything that's going with COVID, more and more people want to travel either, by private airplane or corporate, and that's where Garmin, basically rules. And they recently got approved by the FAA in March for their autonomous landing technology, which is in the Garmin G3000 flight deck, and it's basically it lets these smaller planes to land by themselves. It's a pretty big deal. So that's another part of the business that definitely could, provide some tailwind. And obviously, we also have, the holiday season coming in, so everybody's into buying these type of products. So, the gist of the business is solid. I think as far as risks going forward, it's kind of what I mentioned earlier. It's a problems with potential issues with the supply chain that we saw in the latest ISM, and that's just something we need to keep an eye on. And as far as as charts and the technicals, this stock, it broke out of this this kind of big pre-COVID level not too long ago, and it's now been sitting between 113 and 118 in the past few weeks. It's formed what we call a cup and a handle formation, where stock has a big drop, it rallies back up to the previous high, has another little pullback, and then just kind of charges higher. And you can see on this chart, that's exactly what the status is technically on the chart. So we want a fundamental idea which is solid, but we also want it to be confirmed by the price action. As far as the structure for the options, I don't think there's reason to get too fancy here. I was looking at a straight up 1-for-1 where a calendar spread. So basically buying the January 115 calls for about $5 and selling the December 120s for $1.20, which is a net spend of $380 per contract. And we could have, double to triple profit potential if the stock gets into the lower end of the price target by the January expiration. So that's the stock that I'm looking at, and I'm pretty excited about. So we'll see how that goes.
Yeah, that's really interesting. I know, like, from personal experience as well, just throughout the year, probably like most other people, when gyms shut, the other way to get exercise was just going out and running. So I instantly kind of bought a Garmin running watch. So I'm sure they've had a bit of support from that. And I didn't know about the aviation side, actually. That's also very interesting.
Yeah, so the aviation side is a big deal. But, another thing, like what you mentioned, when you go run, like people have an Apple Watch and you go running out in the sticks or whatever. Well, first of all, you have to have your phone with you, and there's a problem with coverage.
Right.
So a lot of people that are into more like trail running, hiking, all this type of stuff don't want to be dependent upon coverage. So, and there's a lot more options as far as the devices. Not only is it satellite navigation, but it's also like what I have for myself for my boat is satellite navigation, but also communication.
Right.
Which is pretty neat. So yeah.
Yeah. Jason, we'll go over to you now. What about on the long side? Do you have anything?
Yeah, actually, I've got people know me for being a bit of a miserable so-and-so and coming up with shorts, but I've got 2 long ideas today, despite what I said earlier on about the market levels. But I just want to briefly circle back to what Ben's been talking about, because I do a bit of flying myself here in the UK, and absolutely, Ben is 100% correct. Garmin is the only navigation system, avionics system that they use on the private side. There's really nothing else. And actually, you know, your point, Ben, about the executive jet, the private jets is really valid. Certainly for the UK and Europe, there's been actually growth in that sector this year because of the fact that people couldn't use airlines. So of course, if you're rich, you generally find a solution, and the solution has been exec jets, and it's just Garmin for those guys. So yeah, I mean, just anecdotally, I thought I'd throw that in there as well. But in terms of my idea, yeah, so I've been looking at, and in fact, I've gone long of a stock called Big Commerce. The ticker's BIGC. Market cap's about $5 billion. Share price is around about $73, $74. I'm in slightly lower. I got in a couple of weeks ago. So a little bit of background about the company. What do they do? They're a SaaS, so software as a service, e-commerce platform. That's what they provide. I suppose if you want to be simplistic, you could call them like a mini Shopify. They IPO'd over the summer this year at $24. They've actually been as high up as 160 when the price got extremely frothy. So they basically enable businesses of all sizes to build and grow their businesses online. So they give you the ability to, you know, customize your e-commerce platform with pretty sophisticated functionality. They've got an interesting customer base. So they've got 60,000 plus B2B and B2C companies across the world on their books, but they also create online stores for people that we've all heard of, people like Ben and Jerry's, Skullcandy, Sony. So they're helping on that side of things in all manner of businesses, you know, both sort of SMEs, so small and medium-sized enterprises, and up to the big guys. So basically, you know, what can you use their platform for? It's things like catalog management, checkout, order management, store design, that type of thing. In terms of the quantitative analysis, so at the moment, these guys, they're actually not profitable, they're loss-making. Those losses are getting smaller, so that's obviously on the right trajectory. So really, this is a revenue growth story. To give you an idea of the kind of growth that they're seeing on that side, we're looking at basically $148 million worth of revenues this year, which is coinciding with the calendar year, so that finishes obviously this month. We're looking at sales next year of 176 million, and the year afterwards of 213. So basically, you're looking at sales growth, respectively, F1, F2, F3 of 32%, 19%, and 21%. Now, compared to the peer group, it's basically around the same level in terms of the growth rates on the sales side. However, as I mentioned earlier on, you know, these guys are kind of like a mini Shopify. To put things into context in terms of the valuation now, although these are heady, let's face it, multiples, it's the way the business, it's the way this sector trades. So this company is on 30 times next year's sales compared to Shopify on 34 times. In terms of the thematic, it kind of I'm sure our American friends out there obviously well aware we're basically bang in the middle of shopping holiday season now, where obviously e-commerce kind of really comes into its own. I think that irrespective of what's happened this year with regards to COVID lockdowns, etc., that the world is clearly accelerating towards digital. These guys, the reason I like them as well is that they've got scarcity value. There aren't that many of these people out there that are quoted. And when I look at the market cap of 5 billion versus 126 billion for Shopify, I think that kind of works in their favor, as I say, with this scarcity value. Last results were at the beginning of November, strong Q3, and Q4 guidance was slightly ahead of consensus, although I suspect, and I think this is why we're getting the opportunity to buy them. As I say, these things peaked at around 160, having IPO'd at 24 bucks. They're now back to 72, 73. They guided slightly ahead of consensus for Q4, but I think that actually the market was looking for something more aggressive. So they have, they've hit them on the back of that, which, as I say, I think gives us the opportunity. If you look at those results, we look at all their KPIs, particularly this thing called GMV, gross merchandise value. All of their KPIs have showed material strength and actually accelerated in Q3. In fact, today we've had them releasing news about the last weekend, so over Thanksgiving, where they've seen between 74% and 80% growth for their merchants across their e-commerce platforms. So that's obviously extremely healthy. And I think the difference here is that whilst in the early days of the pandemic, basically they were getting much more business from the SMEs, the small and medium-sized enterprises. I think now they're getting business from the bigger guys. So there's guys that I mentioned earlier on, people like Sony and Ben and Jerry's, etc. And I think that the focus always comes to these people around, holiday season. So as I say, I think we've got an opportunity here. Now, a bit like Ben, I'm not going fancy with the structure. Unfortunately, the options, there's a gap at the moment between January and April. And of course, their next results are due in February. So ideally, I'd be looking at some option strategies around February, March, but they're not listed yet. So I'm just straight long a stock on this one. And just lastly, I'm looking for that to get up to 85 bucks. They were, I'm in at 68 a couple of weeks ago. They actually went up to 80 bucks last week. They've come back to 70, 72, 73 today. I think that you should be able to get at least 85 out of these, maybe quicker than the next set of results. But as I say, I can't really do anything on the option side because I'm not willing to go that far out to April.
Mm-hmm. Yeah. Okay. Ben, let's go back to you then. Did you have anything you wanted to mention on the short side?
So there were a few things that that I thought about, but one sector that everybody has been so excited about, and I kind of started to see some cracks a few weeks ago, so I went short home builders, and so I bought some Lennar puts a couple of weeks ago. I bought the 75 puts. The past few days, the stock is actually down almost 10%. So this idea might be a little stale, but I think there's still potential. So I'm going to go through it anyway because it kind of bleeds over into other stocks in the same field. So we all know that Lennar Corp is a big home builder. It's basically the biggest home builder here in the U.S. And there's been in the Q2 we saw this sharp rise in home building stocks. Everybody wanted to move out of the big cities, looking for housing out in the burbs. Which kind of makes sense. Everybody's like, yeah, let's go out there and buy a house, and everything went basically, skyrocket. Everything had to do with housing, and on the numbers themselves, just they look great, right? However, I was looking at, I pay a lot of attention to how stocks react based on what's economical releases and news and things like that. So you can learn a lot from price action, like what stocks basically should be doing based on the news flow and what they're actually doing, right? So I started seeing these stocks actually losing momentum, and that happened back. They actually topped mid-October. Okay, but in the meantime, we're getting all kinds of great housing related figures. Well, when you have a situation like that, when the economical figures are great and the market has been doing well, but the stock just started leaning over, it's telling you something, right? So I started looking into it a bit more, and on the surface, the suburban housing boom seems pretty relentless, and a lot of people think it could have more room to grow, but I don't really. So this reminds me of the last housing bubble. We had a situation where rates are being kept artificially low by the Fed. They can't really go any lower. People already moved out of the cities. It's basically the buying of houses has been done. It came and went. All right. So when you look at the numbers for these stocks, there's nothing wrong with the numbers, because this is a forward-looking idea. So you kind of have to be a little bit ahead of the pack here. So we dig a little deeper, though. There were actually quarterly revenue on a trailing basis, actually topped earlier this year. And it's really not forecast to get back above those highs until late next year, as you can see in these charts. And the main competitors has a similar picture. And we're also seeing lowering of the fiscal quarter consensus estimate for some of them, like in DR Horton, DHI. So, this is one of those stocks where you got to look at it a little closer to see what's going on. And it's not only these stocks. I think this could bleed over to basically everything that's related to the sector. All right, and also if you look at what's going on now with the dollar, the dollar is kind of breaking lower. We could see inflationary pressures creeping up. So the home builder success, it's usually tied to interest rates, and by the Fed heavily purchasing the 10-year notes, obviously rates are being kept at a basically record low. But recently we've seen that the 10-year notes, the prices of the 10-year notes, are actually starting to creep down. So the Fed is maybe taking the foot off the pedal just a tad, and just that little tad is enough to kind of put a scare into the home builders. So cost of raw materials, it's a big deal for these companies. And, as I mentioned with the dollar, there's inflationary pressures that's starting to show. And that could be a big problem. And this is also noted actually in the last ISM report, where Response was saying that they're starting to see some inflationary pressure on materials, and that's from the furniture and related products field. So, and this is also, it's a very supply demand dependent business. And here in the States, there was a forbearance program put in play that was part of the CARES Act, where basically you don't have to pay a mortgage until end of December, and you don't get any penalties, and they're not going to force you to foreclose. Well, that expires end of December. So, we could get a huge stimulus package with a new administration, which is kind of the risk of this play, okay? But other than that, there's really not much supporting it at this point. It's kind of like it's reached its max potential, I think. So as far as the charts go, like I mentioned, the stock topped on November. It topped mid-October, but then it had a pop on November 4th, and after that, it just started rolling over, and the rest of the market was cranking. So it wasn't a market-related thing; it was a stock-specific move. And then the past 2 days, it's been, that downside movement has been accelerated. So they report January 8th. I'm long the 75 puts, but that was from a higher level. So at this point, I would potentially look at a 70 puts. But like I mentioned earlier, there is a thought, at least in my view, that we could get it's been a big move the past few days. So maybe we can get a bounce. We can get in at a little bit better level. But it's a stock where, we're getting pretty close to the December expiration. It's basically 2 weeks left. So it's kind of hard to get out for short. I did, but that was before it had this big sell-off. But it's definitely something worth looking into, I think.
Sure, yeah. And obviously an interesting risk to highlight as well with the new administration potentially coming into play.
Yeah, exactly.
So, Jason, let's go back to you to finish. Do you have another stock you wanted to look at?
Yeah, so this one's actually for us at the Institute, especially in terms of our long ideas, we tend to look, down the sort of size spectrum at the mid caps, seeing, that we can get more, I guess, bang for our buck down at those levels. So, market caps kind of 3 billion and upwards. So, obviously the first idea I gave, that's got a market cap of about 5 billion versus the, whatever it was, 126 billion for Shopify. This idea, I'm going against that convention. The market cap of this company is $48 billion. But let me talk you through it. So the company's called Baidu, ticker's BIDU. Market cap 48 billion, share price is around 139, 140, which is where I've started buying the stock. What do? They are, in inverted commas, the Google of China. So it's a Chinese language internet search provider. They have three parts to their business: search services, transaction services, and an online video platform that has content. I can't pronounce the name of it, so I won't attempt. In terms of the quantitative side of things, we're looking at earnings growth for F1, which is obviously almost finished, is a paltry 11%, but I'm more interested in next year. For next year, F2, we're looking at 22% earnings growth, and we're looking at a P ratio of 17 times for this year, 14 times for next year. The peer group is the reverse in terms of the earnings. So they've got an average growth this year of 23%, next year 11%, which is half of what Baidu is going to be growing at. Again, slightly going against convention here because this stock has been an underperformer, and part of the reason why I'm looking at it is as not really a turnaround, but more of a transformation on the business, which I'll go into. So as a result of that, it's trading at a discount to the sector, because the sector trades on 27 times this year and 24 times next year, and that's to repeat, versus 14 times next year for Baidu, because they're obviously seeing the growth. So going a little bit more into the business, so this is where they're changing the business a bit. So they're basically trying to position themselves as the kind of leader for AI automation in China. Now, if we think about that, they're basically accessing the biggest middle class on the planet, which of course is not exactly new information, but let's just keep that at the back of our minds. So they spoke back in July, about increasing their investments on that front. So they're talking about ramping up their investments in cloud computing, AI education, AI platforms, data centers, all that good stuff. To quote their chief technology officer, at that time he said, the new infrastructure, which encompasses emerging technologies like AI, cloud computing, 5G, the Internet of Things, and blockchain, these will be the driver for China's economic development in the coming decades. So this is where they're putting their money. And essentially, the reason why they've underperformed, and I think that is going to come to an end, is they've had to slightly reinvent themselves as a company, because they were basically restricted by the Chinese government in terms of the advertising revenues that they could generate. So if you remember, the Google business model is, a lot of it is based around advertising revenues. These guys were have been facing restrictions from the government. So they've had to reinvent themselves slightly. So they're now focusing very much on data and AI. So last earnings at the beginning of November, the Q3 report. I'll go into that, but basically as a result of that Q3 report, analysts have had to start raising their estimates. And it looks like the transition is starting to gain traction. So they basically beat and raised their guidance for Q3. Since then, the analysts have already started raising their numbers for this year. They've raised them already by 11%. I'm more interested in next year. So they've raised those by only 5% at this stage. I think that's going to go higher. So we're talking about $8.25 of EPS this year, going to $10.04 next year. That's with the raised guidance from the analysts. As I say, I think that's going to go higher. And they've basically they've guided up, as in the company, they've guided up their guidance for Q4 by 5% year on year, which is a quarter earlier than expected. So as I say, I think the the transformation is already starting to take effect. Now, part of the opportunity here is they're also expanding into live streaming, which apparently is the new rage, probably not that new amongst Chinese young people. Obviously, I'm an old person. I'm not even in touch with Western young people. But apparently this is the rage in China, for basically shopping influencers, all that good stuff. So they announced an acquisition of the Chinese business of Joy Live for 3.6 billion. This was only recently. And that's them trying to diversify the revenue stream into e-commerce and subscriptions. Now, there's quite an interesting research report that came out on that, which I'm going to refer to in a bit. In fact, I may as well refer to it now. So basically, a couple of days after they reported their Q3, a company called Muddy Waters Research, who I'm sure a lot of people out there are familiar with, who specialize in writing short selling reports, basically announced on Twitter that they're short of the company that Baidu's taking over. They basically think that, in fact, I'll quote them, MW, so Muddy Waters, is short YY because we conclude it is a near total fraud. We conclude its businesses, users and cash are a fraction of what it reports. We estimate approximately 90% of YY live revenue is fraudulent, and approximately 80% of Big O revenue is fraudulent. Pretty strong words, and obviously they are short. Now, my point would be, first of all, number one, this is less than 10% of Baidu's market cap. Number two, and obviously Baidu will be pouring, well, more appropriately, their investment bankers will be pouring all over YY to see if there has been this thing called a material adverse change. So a MAC clause is inserted in all acquisition agreements, and the material adverse change clause obviously refers to if something changes between the deal being announced and it actually closing. So there is a MAC clause in there. If Muddy Waters is correct and the whole thing is a total fraud, then clearly Baidu will be able to walk away from this. And my hunch is that actually, if they do that, they're going to buy another company, or they'll just build the live streaming platform internally for themselves. So I think this actually gives us an opportunity. The other thing, which is admittedly, this is a potential kind of like medium-term catalyst. I don't know when this could come, but another part of the transformation is into autonomous driving. Now they could go in with an OEM, an original equipment maker, in some kind of strategic investment, which then would release value from that part of the business. And on some of the numbers that I've seen out there, that could provide an extra kind of uplift of 20% to the stock price. Now, it's a little bit uncertain, when that might happen. So it's not something I can nail, the colours to the mast on, but it's another potential positive catalyst. So, in summary, basically AI, AD are the primary growth drivers for this company, not internet search and advertising. and they're basically all the stronger because this is where the Chinese government wants these companies to go. A little bit of other, further anecdotal evidence. These guys were the first company to build an AI park outside of Beijing, which they did last year in Shanghai, and they're obviously, anchor tenants in that. So bottom line, basically, I think the transformation's already started to happen. We're seeing it coming through in the earnings reports. And I don't think that that their future is going to be defined by streaming stroke, social deals. I'm basically already long, but what is also interesting in this is that there's an option structure out there which you can play for March. So the next report around the 25th of February, I have a conservative 175 price target on this. You can actually buy the March 140s and sell the March 175s. It's going to cost you around just over $9, which basically means that you're in, your break even is around 149, 150. If I'm right and we get the target of 175, that's basically just under $26 upside, which means that you're getting pretty close to that magical 3-to-1 ratio, win-loss ratio that we look for on options positions. So it works out about 2.8. As Ben and I are very familiar with, as we say, don't be a dick for a tick, etc. So I think that's a really good structure to look at. And in fact, I'm probably going to do that in addition to being long the stock.
Cool. Okay, guys, we'll finish up there. It's been great to hear from you both. For all of you watching, if you want to learn more about trading and managing your own money, managing your own portfolio, as I've said on previous episodes, you can find out lots of information from our educational resources on our website. As well as that, I want to point out one extra bit of information here, and that is that we've got a online end of year conference coming up on the 19th of December. That is a webinar conference where all the senior trading mentors that you see on What's on Your Mind and Anton will be presenting on various trading topics that will be really interesting, and it's another fantastic opportunity for you guys to get involved with and learn more from the Institute. So do have a look at that if you can. That's all I wanted to add though. We'll be back next week for our last episode of What's on Your Mind of this year. Make sure you join us then, and I hope you guys enjoyed it.